Good afternoon, everybody, and thank you very much for joining us on the webinar relating to our interim results that came out just after 11 o'clock this morning. My name is Carl, for those of you I don't know, and this webinar has been extended the invite to the Purple team. So a big welcome to my fellow teammates from here in South Africa, the Philippines. We've got a couple in Portugal and a few other places, so a big welcome to all of you. And also to the EE platform users, our community who hold Purple shares. A very big welcome to you. I'm joined by Charles, our CEO, who as always is very keen to engage with users. Charles has been doing some press interviews today. You'll be seeing those in Biz News, Currency News, Business Day. Our results and other articles are out in the media, radio today, and printed media tomorrow. But Charles really wanted to take the opportunity to, as quickly as possible, engage with the team and our shareholders and Easy Equities. So as always, Charles and I haven't met before to discuss what I'm going to ask him. There's nothing that's off record or not allowed to be asked. And you are also all welcome to ask questions. Please put them in the Q&A, not in the chat. I'm only going to look at questions in the Q&A. And we'll take those in a little bit as well. So we've had lots of congratulations and well done, Charles, which is obviously nice, but I'm not going to start with that. I'm going to jump straight into the numbers, and I want to ask you in fact, before I ask you a question, Charles, let me ask you, how are you doing? How are you feeling today?
I mean, they're an exceptional set of results, and I'm very proud of the team. I think anybody who's been watching the last few sets of results shouldn't see this as a surprise, and none of us are surprised. But it's still very rewarding to put the results on paper and get them out into the market.
Cool. So let's jump straight into the numbers, Charles. And I want to start with client numbers. So active clients are now over 1 million. And I want you to talk to us a little bit about that. Do you see this stopping? We're obviously off a much bigger base now. So percentage-wise, where do you see these clients growing? I want you to talk to us a little bit about type of clients we're seeing. Are we seeing clients that are only depositing 5 Rand, clients that are only depositing 1 million Rand? So in terms of behavior. And then finally, how do you think this stacks up against some of our competitors in terms of client numbers?
Yeah, so I think the first thing to kind of unpack is what's the market opportunity in South Africa? We've got 1 million customers, and how big is the runway in South Africa? I think you've got to look at the formal tax-paying base of South Africa, which is around about 7 or 8 million. So there's almost a 10x opportunity in extending our customer base from where it is today to where it could be in the years ahead. So there's still a lot of opportunity to acquire more clients. Secondly, the opportunity to extend the services to the existing clients is just as powerful, just as important, and is another 10x opportunity for us. What I mean by that is currently we serve customers on average, they consume 1.5 of our products. And so as we extend products, we have the opportunity to extend that to potentially 10 or 20 products. And so when you look at the compounding effect of more customers and more products, our opportunity to grow the business is exponential still. And so we've got a lot of runway for growth. In terms of the demographic of the customers we're acquiring, it hasn't changed in a decade. We continue to acquire our biggest customer cohorts that we acquire, young Black South Africans that fit the economic fabric of our country, or the demographic fabric of our country, which still gives me goosebumps every time I say it out loud. But there are some small shifts in customer cohorts that are arriving. One is we're acquiring more and more customers from our competitors than we ever were before. And I think that's a factor. That's the two things that play there. One is the business is much more mature, much more trusted. As that brand and trust grows, I expect we'll acquire more customers. Two, the diversity of the platform in terms of what it offers customers is always growing. And so it's by far the most diverse and the most capable platform in South Africa to service customers' wealth needs. And then three, we're obviously starting to campaign and target and market our competitive platforms. And specifically that 1% cashback on your RA is designed to take customers away from existing platforms or lure them in from existing platforms. So we're seeing the arrival of a much wealthier cohort, and by virtue of the fact that they're transferring in assets and they have more assets, typically about 8 times the asset value of someone who's starting their journey today. And I expect that that's not going to change. I expect that we're going to spend more marketing money on acquiring customers from our competitors, and that we'll keep acquiring their assets as we do. So we are seeing a small shift in the customer value, more valuable customers arriving, but the rate and pace of customers arriving is still double-digit growth, 13% in registrations, just over almost 10% in active customers. And I think as the economic environment eases, and hopefully it eases over the course of the next 12 or 18 months, and what I mean by that is lower interest rates, I expect that our acquisition rates will commensurately go up. So we've got an absolutely enormous opportunity for growth, predicated on the fact that there's still 8 million customers out there we don't serve. We've still got lots of products and runways to build to serve our customers better, and we're acquiring customers from our competitors at a much greater rate than we ever have.
Great. So just talking a little bit more about those numbers. So for those of you who don't know, Charles and I fight a lot about spending money for marketing, because I disagree that we want to spend more money on the marketing. As our product becomes better and better, and we've got such an amazing community, word of mouth is so powerful. But Charles, somebody said to me yesterday, a very engaged user and a big shareholder on the platform, said to me that Easy Equities really is a place for millionaires or for people who are on their way to becoming millionaires. And for me, there was a really good way to describe that we're not just a platform for people investing £5. We very much are. We're not just a platform for people that are investing 5 million, but our scope, our opportunity really is and should be every single person. Because I think what we need to remember is a point you made when you started this platform is investing in shares, investing in the stock exchange is proven over millennia to be the place to make money. And we really want to give that opportunity to everybody. And I think that's the scope. These client numbers, while massive, there's lots more opportunity.
Yeah, I'm going to put my camera on to see if we can the connection stabilize. But you're exactly right. There's not a lot to add to what you've just said, other than to say, there's the desire to be wealthy is a common is a shared goal. That regardless of where you find yourself, you're always trying to create more wealth, and it doesn't matter where you are in that journey. And so and the products and services that you require to become wealthy are also the same. And so it's our job is to make sure that we serve the needs of all customers on their journey towards wealth. And the second, opportunity for us is to, as that wealth emerges, is to start to create products that help them protect wealth. And Easy Protect Life is the first one that we've created, which helps you protect wealth by virtue of the fact that it offers you life insurance, so leaves your loved ones with capital. So it's that's our opportunity set, is to serve everyone with a very core focus on ensuring that the products we build either help them protect or create wealth.
So let's talk a little bit about client behavior. And you talk about cohorts, and for those of you not clear on that, it's simply a way that we refer to people who joined in a particular year. So Easy Equity celebrated 10 years last year. When we started, there were many people who said it wouldn't work because retail investors weren't smart enough. And we had people who joined us when we launched in 2014, Charles. So our cohort from 2014. In your letter, you talk about their contribution, and you say that the clients from 2014 accelerated their contribution by 78%. Just unpack that a little bit for us. What does that mean?
It means over the same period last year versus this year, they've increased their deposits by 78% over that period. And really what the story it's trying to tell is that, this time last year, we'd had no interest rate cuts. And we've had 2 interest rate cuts or 3 interest rate cuts in the period. And what it demonstrably evidences is that customers never went away. They were still depositing, but they were depositing at a lower rate when interest rates were higher. And now, with interest rates coming down, their deposit rates are growing. And what's important in that data is that every single customer cohort you look at the percentages of improvements over last year. They're all double-digit growth and all very impressive contribution growth. And what that means is this is a highly disciplined set of cohorts. Every time there's a relaxation in interest rates. They don't take the money and spend it on themselves. They spend it on investing.
Yeah. And so the clients that joined us from 2020, just to endorse that, they added well over 1 billion, and they were the highest deposit contribution. But the people who joined in 2025 have contributed, well over 700 million. So just talk to us a little bit about the values that we're seeing now on a monthly basis in terms of new money arriving on the platform, and where do you see that going?
So in the results, we said 13 consecutive monthly records. We can now say 14 consecutive monthly records with March behind us. And March, let's talk about March because it's the most recent month. March is typically our biggest month every year. It's interesting. It's first month of the new tax year, and it's almost like people save to participate in March. And so 1.7 billion in new deposits in March. That improved on February's record, which was 1.4 billion. So quite a substantial improvement, like 15% improvement over, or 20% improvement over February. Now, 1.7 billion in deposits it's an extraordinary number. I mean, I just want to reference, it took us 6 years to get to 1 billion in assets. And now our run rate is that in 30 days, we almost add 2 billion. So, these customers are constantly improving their deposits, and they're improving them by about 20 to 25% year on year. And that almost feels unbelievable, and we've had to unpack why. And if anybody who's been watching the data will remember that we've been saying that our average customer age is 32. We've been saying that for a decade. So how the hell are they still 32? Well, it's because we keep acquiring customers that are young. But when you look at somebody who was 32 a decade ago and is now 42, what you realize is that they've been in the fastest cycle of economic growth in their salaries that they're ever going to experience. I mean, anyone knows who's been in the work environment from the ages of 30 to 40 to 45, you're experiencing your fastest economic growth. So these customer cohorts are accelerating their deposits, one, because they're taking investing seriously, but two, they are in the fastest economic growth cycle of their own income statement, i.e. their salary. And so the numbers have got really big. I mean, 1.7 billion, it's a staggering number to achieve in just 30 days of deposits.
So I want to interrupt you there, and I'm not sure what I'll be accused of, because it might be the first time that I'm going to say that you're not being arrogant, but you're not being arrogant enough. Don't compare that to easy equities. Give us a sense of how that compares to other financial institutions, banks. Is that an impressive number versus other financial institutions?
Look, it's hard to, I mean, I think it is. So, when I say it out loud in front of our peer groups, our competitors, it's kind of jaw dropping for them. So, and I don't know their numbers, but it is jaw dropping for them. But let's have a look at, let's just take one competitor, and they're not really a competitor, Time Bank. I mean, it's not a competitor. But in their most recent published data, they're not financials, they said that they added 600 million of new deposits in 6 months. So, and that's a business that's valued somewhere near 20 billion, somewhere near 10 times our valuation. And yet our capacity to acquire deposits is almost 3x theirs. In fact, it's more like 5, 6, 7x theirs. So I think in the context of South Africa, it is a very impressive number. I think what's very impressive about it is not just the quantum, but where it's coming from. Just remember, this is coming from, on average, 32-year-old South Africans who 10 years ago people said didn't have the capacity to invest. Well, they're proving that was never true.
Yeah, really interesting. Charles, let's talk a little bit about product offering. So Easy Equities launched One Wallet, ZAR, you can invest in shares listed on the Joburg Stock Exchange. That's increased dramatically. Ability to invest wallets, foreign wallets, whole bunch of products. What is the tension between that's offering too much, too confusing, users are spoiled for choice, we're losing focus, versus the argument that it's enabling people to have all their investments on one platform easy? Why have you chosen this route? Why are you strong on the route of adding more product?
Because, the more that you can serve your customers, the more average revenue per user you can acquire. And that's not just around delivering profits to shareholders. the more revenue you can get out of a customer, the better you can serve them. The more capacity you can build, the better your platforms can be, the more you can invest in growth and new products and all the things that they require on their journey to wealth. So it's important for us to scale the business, not just vertically, but also horizontally, so that we have a depth of product that delivers us greater ARPU from our customers whilst acquiring more customers all of the time. And if we get those both right, we create incredible flywheels for more investment in our customers and obviously in returns to our shareholders. And so, it's what's also important. And sorry, the point that I didn't make is we don't build these products sitting in a boardroom wondering what our customers need. They vociferously tell us in very social places what they expect from us. And so if your customers have an expectation that you should serve them in certain areas and they trust you, then you should go out and build and service them in that way. And the privilege that we've got is the incremental cost of adding a customer to a new product is zero. There are 2 million customers out there where the incremental cost to add them to a new product is zero. Now that you think about the privilege that is for us to think about new products and services and to scale those products and services. Anybody starting, as an example, the life insurance business today doesn't have the privilege of accessing 2 million customers at the click of a button. Doesn't mean they're going to consume your product, but it does mean you can learn a lot about what you've got right and what you've got wrong in that marketplace. So, for those that say that we do too much, well, they're obviously not customers of ours because our customers expect a lot from us and they expect much more from us. And for those that say that we're not focused, we are. We're super focused. We're super focused on what our customer needs and ensuring that we execute it towards those needs. We're not distracted by anything else. We're not distracted about competitive forces. We're not distracted about macroeconomic environment or what's happening in the US. We're focused on what our customer needs are and delivering to them.
Yeah. And just a bit of insight, many of the people on this call will know this, but for those who don't, there are lots of fights and strong debates and argument behind the scenes in terms of products and product offering, and why we should and why we shouldn't. And at the end, what wins is what the customer wants. So let's talk about some of those products and relate it to some of the questions we're getting. So Easy Properties. Easy Property was directly started by users saying, I want to invest in property. I don't necessarily want to own a home. I don't like some of the traditional ways of investing in property. We've now got close to 50 odd properties. We're expanding. And there's a question here from one of our very engaged users, which we appreciate, Sean, asking, is there perhaps a plan to put all of these in one portfolio and list them on JSE, like a REIT? Or is the plan to just add more properties, special purpose vehicles? Do you even think about Easy Properties anymore? Or is it such a small thing in the business?
No, we think about it a lot. I mean, the best way of describing Easy Properties or to think about Easy Properties is an asset management business. It's like passive investing in property. And asset management businesses are hard to scale. They take a long time to get to the point where they're profitable. Typically, in the South African context, they need to get to about 2 billion rand in assets for them to really, show some decent profit. So where is Easy Properties today? It's at 500 million in assets. So it's, I would say it's 25% towards what it needs to achieve. We're patient with it because you can't just go out and buy 2 billion rand of property. You've got to find the right property and then match that property to the customer base. But I expect that as the property market improves, which it is improving as interest rates come down, we'll accelerate our growth in that vertical. And the nice thing about once that reaches critical mass, which in our lives isn't 2 billion, it'll be about 1 billion. So it's 50% of the way there. It just delivers profit. There's no incremental cost in adding new assets and therefore new revenue. So I'm very comfortable where Easy Properties is. I think the future isn't to list those on the JSE. It serves no purpose. We acquire more customers, retail customers, than the whole of the JSE. So why go and access it, put it on the JSE and increase the costs, which invariably will reduce the returns. So yeah, it's a product we think a lot about, but it's a product that was always built for the long term. And it's now 5 years old. And I would expect that it'll be profitable in the next, 2 or 3 income statements.
And just as a reminder to everybody who's invested in those properties, it's a substantial portfolio, as Charles said, and we can all be proud of that investment. So carrying on in terms of the products, and another engaged user and somebody who knows the business well and keeps us on our toes, Junior, Buffett Smith. Can you talk a little bit, Charles, about some of these other products? And I just want to unpack one at a time and link it to some other questions. So let's start with Easy Trader. So perhaps falls a little bit outside the more traditional suite. Easy Trader is not coming soon anymore, Chris. Easy Trader is here. So I think, Charles, just give people a sense of where can they access Easy Trader. Is that not in conflict with investment? Is this not a hangover from your past life? Why is this an important element? And why are we so passionate about it?
It's definitely a hangover of my past life. Like I've been doing this for 24 years. But trading is a meaningful part of the market and can be a very meaningful part of a customer's risk and investment journey. So it's a great risk management tool because you've got the capabilities to go short. You can create structures that hedge your existing portfolio, etc. So it's a meaningful part of the investment landscape and wealth landscape, and so therefore it's something we need to serve our customers. It is live. It's live still in a whitelisted format. So if you want to get access to it, just raise your hand somehow to the team, and they'll add you to the whitelist.
Tristan's posted the link in the chat for those of you interested.
Perfect. And then for us, about 5% of investors end up being trade as well. And so if you think about that market opportunity, there are about 50,000 traders on Easy Equities already. And so it's not about getting 1 million people to start trading. It's about taking that 50,000 that are already trading and potentially trading somewhere else because we never service their needs, and retaining them with us. Because if we understand your trading behavior and your investment behavior, we can obviously serve you better.
So some of us gave you a bit of a hard time when we went off and put our hand up for active ETFs. Fast forward a little bit, 3 products, an exceptional team, smart. Talk to us a little bit about assets under management. What is the value of Easy ETFs at present? Have people bought into it? And what are the ambitions around Easy ETF?
Yeah, so maybe it's worth just restating why I think active ETFs are important for us. Unit trusts will cease to exist as a result of active ETFs, and the only difference between that statement and it happening is time, or the only thing between that statement and it happening is time. Unit trusts will eventually be gazumped or displaced by active ETFs. And so and unit trusts are traditionally a retail product, and therefore active ETFs are going to be a retail product. And so if you're the largest retail distribution platform, you have the largest opportunity to serve your customer needs in respect to active ETFs. And so leveraging our brand and distribution and building a meaningful active ETF business is a great opportunity. More than that as well, we understand our customers' investment behavior. So our ability to build product in sight of their behavior is a huge strategic advantage. There are very few asset managers, I can't think of many, who understand their customers' investment behavior. So how do they build product to meet that investment behavior or complement it? So I think that active ETFs over the next decade or two will displace unit trusts. I think Easy ETFs has the right and the opportunity and the distribution and platform to be the largest active ETF player in the market. Today, I don't know where we rank, but we almost got to 1 billion assets prior to this Trump tirade. But 1 billion assets in a very short period of time, very happy with what the team have done. And clearly there's a strong product market fit in what we've already launched.
Cool. We spoke earlier on about deposits and the 1.7 billion in March. I want you to please talk a little bit about institutional versus retail as we talk about Easy Retire. So Easy Retire from institutional and retail perspective, and where we're seeing the value there, please.
Yeah, I mean, the analogy I like to use between institutional and retail is, hunting for institutional clients is like being a long line fisherman. Like it's like hunting for marlin. It's hard, but when you catch that fish, the rewards are impressive. But it takes a lot of time, and you don't find them in all waters. Where retail is it's like trawling for fish. There are lots of different species out there, and you get to hunt them in all sorts of waters, and so you acquire them all the time. And the nice thing about them is that they diversify the business and the risk profile of the business in terms of the customer types. Typically, institutional clients are unaffected by what happens in interest rates because the money is much stickier. It comes from your retirement savings. It comes directly off your payroll. So it's stabilized, and the revenue you earn from institutions is much more annuitized. It's much more annuity driven. And you can see that revenue base is now over annuity style revenues, over 50% of our revenue in the group. And that gives you a great level of stability in your earnings. Whereas in the retail space, you have less stability in your earnings because most of the revenue that you generate is very transactional, and so they've got to do something on your platform for you to generate revenue. And so our opportunity is to do both. At the end of an institutional client is just another retail customer, so the needs, wants, and desires of an institution are exactly the same as retail. And so just leveraging our capability into both markets gives us a far greater market opportunity. And to put that kind of in assets, there are trillions of rands of opportunity sitting in the institutional space. There is maybe R1 trillion of opportunity sitting in just direct retail. So, institutional space is multiples in terms of the assets that are out there to acquire of what's in the retail space. But what is important to understand is at the end of that, the money still belongs to retail customers. So the needs, wants, and desires are still the same.
Thank you. So just to give you a minute or two to catch your breath, many of the questions are covered in Charles's letter in our annual financial statements that are available purplegroup.coza financials. If we don't get to them, please check that out. If you haven't accessed blogs.easyequities.coza, please do so. Isha and the team put regular content there. There's fantastic updates there regularly. There was a question around students and secondary school education. Veronique partly answered that through the academy. The work that Veronique and the team does in the academy, there's a lot of resources that we're putting out into primary school, secondary school, tertiary. We're really putting our money where we believe it needs to be focused, which is helping investors educate themselves. So please check out all of those resources as well. So Charles, next up, want to ask you a little bit about, one other thing I want to say, those that are asking questions around the platform and making suggestions around platform, and also people around the stop losses, etc. Veronique and Almir and his team will answer. But again, all the information for that, support.easyequities.coza, type in your question. Go to Academy, go to blogs. 99.9% of what you're asking, the information is there, freely and easily accessible. We'll answer as much as we can, the team, on this, but please check that out. So Charles, I want to ask you a little bit about the partnerships, a couple of questions around partnerships. So how are you seeing those evolving? Now, it's difficult to talk about it as a group because they're all obviously different. So let's start with Discovery. How are you seeing Discovery?
Yeah, I mean, what a fabulous partnership. Every time I walk through the airport fast lane and see the Discovery brand, I'm reminded that, we're privileged enough to be partners of theirs. The partnership has taken time to understand each other well, and to align our strategies, to understand where our strategies align rather. And what you can expect in the future is that much tighter collaboration around Discovery Bank and Easy Equities. And what that means for the customer is much better servicing from both of us. So, as we work together, the two platforms have come together better over time. We're going to continue to build products and services that make that fit even more comfortable or more rewarding and engaging for our customers and their customers. And the nice thing about Discovery is that typically the customers that arrive are private bank customers, so they're high value customers and slightly more sophisticated than other channels, well, more sophisticated than the other channels that we acquire customers on. What I love about working with Discovery is that, if we think we're innovative and fast-paced, they show up at fast-paced and innovative. And so it's amazing to work with them, the speed of which they innovate and are driving change in the bank, and the opportunities that presents us to align our products and services is very rewarding. And I think that partnership is going to yield very significant growth for us, simply because Discovery Bank is growing really fast itself.
So just before you talk about the others, a few additions on Discovery. In May, Easy Equities been invited by the Discovery Bank team, and we're very pleased about that, to be a part of their airport branding. And our partnership team have got some really nice angles to amplify that for the community, ways that you can get some benefits from that, ways that you can win some shares and some cash. But Easy Equities will be part of Discovery Bank at the airports. So that is Cape Town and Joburg, and also international arrivals in Joburg. So that's very exciting. And also been having great conversations with the marketing team of Discovery Bank. And there's some really interesting data where people are spending their money in Discovery Bank. And many of those are companies that you can invest in. So a reminder to people, if you are spending money at Woolworths, consider investing in Woolworths. If Discovery Bank is your bank, just consider investing. It's one of the ways that we were founded. Sanlam, Charles, as a partner. And
Yeah,
partnership.
I mean,
Sanlam.
Yeah, we partner across the group with Sanlam, and so there's so many meaningful opportunities that we've already executed on, and not everyone, I think, is aware of all of them. So Satrix is the obvious one. They're our biggest partner, and continue to be our biggest platform partner, and they've been with us for 8 years now. And you see their brand in the market probably as much, if not more, than you see ours, which is fantastic for us. And that's a team that we've got a long relationship with, and very strategically aligned with. But beyond Satrix, we work very closely with Sanlam Fintech. Sanlam Fintech underwrites our Easy Protect Life product. So that's how we built that product in partnership with their fintech team. Out of interest, we also work very closely with Glacier, their list platform, which executes all ETF flows into the JSE via us. And that's a substantial amount of assets that flow in to our platforms through that partnership. And then behind Easy Credit is Sanlam Credit. So, those are just examples of the relationships that we forged across the Sanlam group. And there's much more for us to do. I mean, Easy Retire, we talked about it earlier, but the retail arm of it, which is to partner advisors onto our platform so that they can bring their customers and assets to our platform, and their customers can get served in the same way as our customers do. There's obviously a huge opportunity to do that across the Sanlam group, to build a capacity for their advisors to use Easy Equities as a platform in the group. So there are lots of additional opportunities to work with Sanlam, not just in South Africa, but globally. Anyone who's watched their strategy knows they're investing heavily in India. We're staying close to that, and I understand where there's an intersection for us. They're very active in Africa, and we've just got licensed to enter Kenya, so we're now licensed, and we'll enter that market the next couple of months, and other parts of Africa. So Sanlam have been, and sorry, everyone knows or should know that they underwrote our rights issue 18 months ago. They didn't get any capital as a result of that, but they also were invested 100 million almost 10 years ago in Easy Equity. So incredible partners who've enabled amazing growth and continue to help us unlock value in partnerships and distribution across the group.
Capitec, recent announcement of a new CEO. Thoughts around that and our future partnership with Capitec?
Yeah, what's interesting is the new CEO did the deal with Almira and I, the original deal with Almira and I. So it was thanks to him. It was him and Francois, one of the other Capitec employees, but two of them were responsible for bringing Easy Equities to Capitec. So we've got a very good relationship with the incoming CEO, and congratulations to him. What an amazing opportunity to be CEO of Capitec. Capitec for us it's like having access to distribution to 50% of all banked customers in South Africa for free. Can you imagine if you could put your signs on 50% of the roads in South Africa, and advertise your products and services for free? And that's what Capitec does for us. It allows us to acquire customers at zero cost by being on their rails and in their channels. And we're, again, a bit like Discovery, we're learning all the time on how to partner them better. They've recently, in the last 18 months, they launched Live Better, which is their loyalty program. We think there's a stronger strategic fit for Easy Equities to be present inside the Live Better app, which is going to launch this year. And so we'll be available in 2 places this year, not just inside the banking app, but also inside the Live Better app. And we think we can, using loyalty, or just using their loyalty, we can tie customers to Easy Equities better. So, and you've seen their growth numbers. Capitec continues to smash growth numbers out the park and surprise the market. And we benefit from that growth. At least 20% of customers arriving every single day are a result of Capitec distribution channels. And those customers come at zero cost to us, which is, it's just, again, such a privileged position to be in, sitting inside that growth engine and getting customers from them for free.
Carel and the Live Better team are doing some great stuff with Brad and his team on our side. And it was interesting listening to them because, when 50,000 or 80,000 clients pitch up, Kelly's, disappointed because the numbers are so massive at Capitec. When they run a campaign, it's 500,000, 1 million people that pitch up and they don't bat an eyelid. So we're very excited, as you say. Last one, Charles, Philippines. Partnerships, Philippines, on hold, happening. Thoughts around Gcash and any updates you can give on that.
Yeah, I mean, firstly, I've got to remind people why we're in the Philippines, and there are 2 reasons. One is there's an extraordinary talent pool for engineering resources and other skills that we're using, and so we've got 70 or 80 staff in the region. Carel, how many staff in the Philippines? You'll know better than me.
68, yeah, 68 give or take.
Cool. So, and that's the first reason to be in the Philippines. Extraordinary talent pool and ability to acquire that, to hire this and that talent pool. And the other thing is they're in the right time zone. So they give us the capability to serve our customers 24 hours a day. That's the first reason to be there. The second reason was always the partnership with Gcash and the ability to serve their customers with international stocks. We have won the right, as everyone knows, to do that. The only thing stopping us is the regulatory framework to support that right. Updates from that regulatory framework is that they are creating a sandbox into which we will be invited to participate and to start acquire customers inside that sandbox. And we expect that will happen in the next 12 months, but no promises and no commitments. We are going to stay in the Philippines until such time as that market opportunity is regulated. And, my best guess is that'll happen in the next, 12 or 18 months, but that's a guess. And we'll just keep the market abreast of what's going on. But, when it happens, and it will happen, we will eventually get access to over 90 million customers through one distribution channel, Gcash. And so it's, whilst it's been disappointing in the delays, it's well worth the wait. We are confident that the regulatory acceptance for what we do and how we do it is growing, and our work in the market is gaining more and more acceptance all the time, and our partnership with Gcash gets stronger as we work with them to get over this regulatory hurdle. And at some point in the not too distant future, we'll get the right to launch to 90 million customers.
Thank you. I want to talk a little bit about expenses. We've also had a great question from Ines around that. Revenue growth versus cost growth has been impressive. What are the next operational levers to extend that margin advantage further? Or do you think we're going to fall back into a massive spike in expenses? Thinking in the way that you and Gary, our CFO, handle that.
Yeah, great question. And actually, if there's one line in my CEO letter I want everyone to rehearse and remember, it's the following one. For every 100 Rand of revenue, 70 Rand turns into profit. The reason I want you to remember it and rehearse it is because I want you to hold us accountable to it. We hold ourselves accountable to it. We've worked very hard to get to this point. Every year we've talked about our cost to serve coming down. Every year we've talked about our ARPU going up. If you've been watching our income statement for the last 2 or 3 years, again, it shouldn't come as a surprise that this operating leverage, which is evidenced in these results, and if we just talk about that for a second, results that came out in November, so the year in August, our PE was 50. As a result of these results, our PE is closer to 20. How has that happened? It's happened because 70 Rand of every 100 Rand of revenue has flowed to the bottom line. And that's operating leverage in action. And that operating leverage is something that we are going to protect very, very carefully. One, we want to extend our ARPU, and we really talked extensively about how we're going to go about that. Two, we want to continue to challenge our cost to serve. We think AI, as an example, is a great enabler of reducing our cost to serve. Interestingly, growth reduces our cost to serve. So as we grow in customer base and to utilize our scaled capability in our technology stack, you add more customers, you actually reduce your cost to serve, which is counterintuitive to my thinking anyway. So we expect that we can retain that margin. We want you to hold us accountable to it. We are holding ourselves accountable to it. But it's the magic number in the income statement this 6 months. It's an indication of what you can expect from us in the future in terms of profitability as we grow revenue. And importantly, it's also our biggest differentiator when we find ourselves in competition with others. Because if we were starting Easy Equities today, every 100 Rand of revenue delivered 0 in profit. Profits give you the ability to invest. You could use that capital to grow faster, invest in your customers, grow your platform, or deliver it to shareholders. The luxury of sitting in a scaled business like we are now is that we've got those choices. We can choose to invest or return it to shareholders. Getting the balance right is the important part, and we'll continue to strive to get that balance right. But we're in a very privileged position because of that scale that we've got, and the ability to deliver this, the revenue 70% of the revenue directly to the bottom line, I think is our single biggest differentiator and the most valuable asset we have in the group. And so I hope no one's surprised. We've been talking about it for a long time, and we've put a lot of emphasis and focus on it in previous results, and you can go back and read them if you like. But we've delivered it, demonstrably evidenced it in this set of results, and you can expect the same going forward.
So a question that ties in with that, but might be seen as patronizing by some, and putting you on the spot here, both for our shareholders and staff, and for those of us who are both double whammy. So with everything that you've said, the business is doing well, really well. Our pipeline is extremely exciting and grounded in factual plans, and our cost base we're maintaining. Why are we not paying dividends? And why are we not tripling everybody's salaries and paying big bonuses, which some people seem to think we need to be doing?
There's so much opportunity for us to invest in growth. You pay dividends when you've run out of growth ideas, and that the best thing you can do with the capital is give it to shareholders. And you're kind of out of ideas, and we're not out of ideas. We've spent the whole most of this discussion talking about all the things that we need to do: new products, new region, new customers, new platform capability. There's just so much to do with our capital. The good news is we've got a war chest of capital that we've never had. We've got 170 million sitting in cash on our balance sheet. I was chatting to Julieta Televi earlier, and I said to one of the beautiful things about where we find ourselves in this highly competitive environment versus 10 years ago. When Easy Equity started 10 years ago, we invested 2 million Rand in this market opportunity. We were the only new entrant that year. So retail investors were literally getting 2 million Rand of new capital spent on them. Today, we're spending 300 million Rand a year on retail investors. And there is an emergence of new competitors spending money. And so in the outcome, retail is just going to get a much better deal, from the competitive forces that are prevalent in the market. But these are big and substantial numbers that we're delivering. And sitting on 170 million of cash gives us the luxury to think about two things. One is, are there areas of our existing business that we should be investing more in to drive growth? Is that marketing? Is it a specific product? Is it multiple products? Is it Thrive? Is it platform? We've got the capability to turn up the capital there. Or two, are there acquisition opportunities where we can accelerate our product aspirations or regional aspirations by buying a business? So, for example, is there a little Easy Equity sitting somewhere that if we could go and buy that would accelerate our entry into a market? Or is there a product vertical? Let's just say a neo bank, which isn't something that we would buy, but just using as an example, is there a neo bank operating in South Africa that would accelerate our entry into banking? And we can use our capital. So sitting with 170 million Rand on capital, the important part, or the obligation we have, is to make sure we invest that in growth. If we don't, we should give it back through dividends to our shareholders. but I can tell you for free, we've got no plans of doing that.
Great. And just to give you an opportunity to catch your breath, and then we'll wrap up. Just a few quickies. Thanks to Veronique and the team answering the questions. Again, support.easyequities.coza, blogs.easyequities.coza, our academy. It's got all of this information on there and relevant for you. So please check that out. Chris is asking the main difference between Easy Equities and some of the competitors. I'll quickly answer that. Clarity, for instance, you don't own a share. It's a CFD, so you don't have real ownership. Small universe, not the broad spectrum and Easy Equities. Standard Bank and some of those others. Check out the cost profiles. We disclose ours very easily and frequently. And so cost is definitely better. From Easy Equities perspective, fractional share ownership from a ZAR perspective is patented by us. So there are a number of differences, and biased as I am, I think the ease of use, the cost, and the diversity of product makes us the platform to be. So Charles,
Carel, I just want to mention that quickly. Just like if you think about everything we've talked about, and let's just talk about the scaled businesses, where in South Africa and globally, even globally, where can you buy access to, large scale residential developments alongside local and global stocks and unit trusts and ETFs, alongside 70 to 80 crypto coins and scaling all of the time, whilst servicing your life insurance needs and taking out a loan. Where can you do all of that? And I haven't mentioned everything we do, Easy FX, Thrive and everything else, but where in the world can you do that? And I promise you now, you can count the number of places you can do that in the world on one hand. And there are none of those competitors where you can do that are in South Africa. So for us, the competitive environment, whilst improving in South Africa, and I want to really express this without sounding arrogant, because it's not arrogant. There is nothing better for all of us than a more competitive environment. I am a competitive animal. I can't swim down a lane in a swimming pool without looking left and right to find somebody to compete against. Competition brings out the best in me. It brings the best out in an industry, and therefore the retail investor will get what they deserve, which is the best products and services. So I am so happy to see competition. But for us, when we reference the competition on a global landscape, we're best in class. We're in the top 2 or 3 providers in the world when you stack up what we do. And for the rest of the market competitors, they do small parts of what we do. They don't do everything that we do. So we welcome them. I can't wait to compete with them. But there are very few of them where you can serve all of those needs and a growing set of needs in a single platform capability.
Moving to a close with a few wrap-up questions, Charles. Thrive, just a brief thought around Thrive. So I personally find it interesting when people say that there was this outcry. We loved the engagement when Thrive was launched. I'm very proud of the fact that we've stuck to supporting our users through education and a whole bunch of other stuff. Do you see Thrive as continuing? Do you think it's a success? Just brief thoughts on Thrive.
It's a radical success. What are the behaviors and why did we deliver it? What were we trying to resolve? We wanted our customers to pitch up more often and take investing more seriously. Tick that box. So you can see it in the numbers. Customers are pitching up more often and doing more with our platform. What are the things we wanted them to do? We wanted them to deposit more money. That's happening. We wanted them to educate themselves more. That's happening. We wanted them to consume more of our products because it's good for them to have a diversified portfolio. Guess what? That's happening as well. We also wanted it to shore up parts of our income statement, i.e., we realized there was a value exchange. We look after your assets 365 days of the year, and we charged you nothing for that. So if you never pitched up, we make no revenue. And people were very happy to pay us 25 Rand a month in order to serve their customers their assets 365 days a year. And so it served all of those purposes. It's helped our income statement, and it's shaped and continues to shift behavior. And there's lots more to come from Thrive. It's just getting started. So it's a radical success. And I don't find anyone anymore in the public space who moans about it. My response to them always has been, I get out of bed every single day to serve my customers. In order for you to avoid a fee, You just need to get out of bed once a month and deposit R1 and you avoid your 25 Rand
Yeah,
fee. I think
absolutely.
it's a fair value exchange, and there are 250 of us who get out of bed every single day to serve our customers' needs. And I think a 25 Rand is a fair value exchange.
And we've put a very senior resource and experienced team member that's going to add some added impetus and strategic oomph behind Thrive. So there's lots of exciting things going down the line. Subscriptions, and this addresses Ines' question. So Ines is saying, with ARPU and inflows up significantly, and I'm loving Ines' questions because he's also reading the information that's out there, and I would strongly encourage everybody to do that. But he's saying, what's next in driving monetization? Do you see room for premium services, advisory layers, deeper wallet share per user? And as this is interesting because we have big fights and debates around this. I'm often really not keen on some of these subscription services. I'm the vast minority at Easy Equities. So Charles, maybe talk a little bit about subscription and the thoughts that you and the growth team have around that.
Ines, I mean, you're right on the money. And, it's not, it doesn't, you don't need a crystal ball to see where we're going. And what's interesting is that we're not alone in going there. I mean, you look at what Robinhood's done and the success they've had with subscriptions and monetization of areas of their platform. And, they recently bought an advisory tech stack. And guess what? We're looking at advisory tech stacks as well. So it's almost like our strategies are being written by the same person, but they're not. But it's just because it's obvious our customer needs are the same. And I talked about that earlier, that we're delivering to our customer wealth needs. So, will we be doing all of those things? Yes, we will. Which are the ones that are prioritized for the next 12 months? So Easy Subscriptions is prioritized for the next 12 months. And it really is focused on delivering more value to customers at a fair value exchange. So, exactly as the word suggests, you'll be a subscription service that bundles a set of services, products and services that delivers more value than what the subscription amount is. And we'll launch that probably in the last quarter of this year, but if not, first quarter of next year. So doing a lot of thinking and collaboration with partners. So talking to the likes of Discovery Bank and Capitec and other partners to think about how they can augment that subscription service. So that's on our radar. And if you look at what Robinhood has done with their Robinhood Gold, we won't be a long way from that. I think we'll do better, to be honest. We're thinking, I think, more broadly than they are. And then the other one, which you just highlighted so well, is advisory. As our customers are older, their need, the desire, what erodes? Their capacity to invest goes up, time goes away. And time goes away because life happens. They're taking off, they're having kids and getting married and all those kind of things. And so what we've got to solve for them is how, and if we don't solve for them, they'll go and seek out a platform that does, or an advisor that does. We've got to give time back to them. And we've got two strategies to give time back to them. One is we want to partner advisors and allow them to onboard their customers onto our platform, but while also servicing our customers. So they'll get distribution from us. And so for customers whose time has been eroded and who don't want to manage their own portfolios, and financial services, they'll be able to do that within the next 12 months on our platform. The second one is AI. How can we leverage AI to give time back to our customers? How can we leverage it for them to build their will, or to help them set up a trust, or help them manage their portfolio, or create an education fund for their kids, and a whole host of things. And we've tested these things internally using AI, and the results have been extraordinary. So for us, we're taking a two-pronged attack on advice. We want to enable human physical advice because we think the future is full of humans, but we also think the future is full of AI. And in fact, the combination of those two things is, we think, where the sweet spot is. Humans who partner AI to deliver services are those who are going to win. And so the other service that you talk about will be delivered through AI and humans.
Thank you. We've got a question from Ramakunoto around why we can't earn interest on our uninvested cash in our non-ZAR wallets. Ramakunoto, I'm with you, mate. I would love to know the same thing, and I know the team were looking at this, and so we'll flag it for our finance guys. And if Isha from my team can just please make a mental note that we respond via a blog.
Carel, let me just interject. There are interest-bearing products on all of those platforms. So you can buy government bonds, US government bonds. You can buy money market ETFs in those markets. So don't wait. It's, we're not a bank in that market. We don't have the kind of relationships. We don't have the same capital resources that we do in the South African market. But what we did is made sure that there were interest-bearing products on those platforms, very low risk interest-bearing products. So just do a bit of research. If you want to use the AI tool, talk about AI on our US platform, there's an AI tool, and say, give me a portfolio of interest-bearing ETFs, and it'll spit it out for you in about 2 seconds, and you can go and buy that, and you can start earning yield immediately. So don't wait for us. Those products are already available on our platform.
Great idea on the using the AI tool, but Isha can also do a blog, and I know she has done some work on this in the past, just highlighting that again. So to conclude, a couple of points. Firstly, a big thank you to you, Charles, but also to your family. I know you've had to, busy with something personal, have to stop in the middle of a storm that we can talk, but I specifically want to mention your family, apart from the fact that I'm a massive fan of your wife, as you know, but because of the team on this call as well, and a big thank you to you and all the people that are close to you. Because family and health is vitally important. And whilst we get up every day, 250 people to serve our community of Easy Equities, is the people around us that enable and support that. So a massive thank you to not only the team, but all the families for everything that you do. To everybody who's joined on this call and all the investors, thank you very much. Thank you for your challenges, for the debates, for the arguments, for the support. It really does excite us and make us happy. And I want to conclude by answering the question directly around the share price. A couple of you have asked questions of you, for Charles, and the share price. And I'm not asking Charles that question. I'm asking all of you that question, because it's not Charles's to answer. We don't focus on the share price at Easy Equities. We focus on delivering the stuff that Charles writes about in his CEO letter, and doing that to the best of our ability, effectively and efficiently. The share price needs to take care of itself, and it needs help from the million people who invest on Easy Equities. It needs help from the people on this call. You go out and you tweet, you talk about it at a braai, and Shabeen, wherever you hang out, you talk about the stuff you've heard before, the stuff that we're doing really well, the stuff that we're proud about, the stuff that we don't do well, that we acknowledge in our plans for fixing those. Then the share price will take care of itself. It's not a call for our CEO to make. It's a call for every single person who's invested on the platform, who works here, is in this community, to talk about it. And then the share price will take care of itself. So a big thank you to everybody for joining. We have regular sessions. We put out a lot of information. So check out the social media. Jonathan, I'm forcing him to take a bit of leave because he's so passionate about keeping all of you informed through social media. Check that out. And without any further ado, a massive thank you to all of you, and we'll chat again soon. Thanks very much, Charles.